This panel is about market reform. Power markets in Europe are probably broken as they are at the moment. There's a fundamental need for flexibility. It's probably growing, but investors ultimately need to be willing to take on more risk.
On one side, we are seeing that the current prices do not support any investment whatsoever. On the other side, you need to reform the system in a way that you start valuing flexibility and capacity along the energy component.
The big barrier in terms of implementing energy-only market reform is politics.
There's an expensive way to do it and there's a cheap way to do it. The really expensive one is to put in place capacity mechanisms that will effectively lock in the existing mix of generating resources, which means that as we continue to deploy more zero-carbon resources, the surplus will continue to grow, wholesale prices will continue to decline, and we will have zero price information available to drive more flexibility on the demand side. That's the expensive approach. The cheap approach is to get rid of surplus capacity and to amp up the information being provided by energy and balancing market prices so that they reflect not just the marginal cost of fuel, but in fact reflect the full cost of keeping the system in sync with the established security supply standard with the combined demand for energy and balancing reserves. That's the cheap way to do it.
At the moment, we've got a system which is central power plant transmitting electricity through distribution to business customers and to domestic customers. That's getting changed on its head. New technology allows generation to be done next to the customer. That flexibility of service means that customers can not only manage their needs more rapidly, but they can also export that to the industry as well and get some revenue from that.